It's time for another one of our market reviews. And as you can see, we got a little pop in the market and of course it turned around. But the good news here is that we actually made a lower low. Now, of course, this is all very short term. This is only between a couple of days. But you see these wicks right here on these days, especially this one? That all means there is a solid floor here with buyers coming in and supporting the market. Because what we didn't want to see was the market going up and then turning around and making a lower low. The fact that it was stopped right here, that's a good sign. Now, of course, as I'm recording this, you're seeing the market drop lower past that point again. But as you can see right here, it's sort of stopping at that support, the same one that was put in right here. So the question is whether this will hold, or if it breaks here, will it just go down to this bottom, or worst case scenario, it makes a lower low? Because what we've been expecting in the market is a multi-week bear rally, meaning that no, we're not out of the bear market, but this would be a playable rally to the upside where you could make some money. And of course, more than just looking at the technicals and the charts, there are fundamental reasons to support this. And that's where we'll get into our macro ops research. And macro ops is our global macro research and consulting firm. And our latest market note talked about how price gets made at the margin. Now, like I said, we're likely in a bottoming process and about to embark on a multi-week rally at least. And when we talk about bottoming, we think it is a short-term bottom because we do think the market is going to go sideways to lower for at least another year. But you never know, like this bottom could turn into a permanent bottom. But our base case is multi-week rally at least. So some of the data to support that, and these are quick bullet points that we'll go into detail in a second. But the Bank of America bull and bear indicator is nailed down at 0. Extreme bearishness, and that's what we look for in the market, right? Sentiment and positioning. We're looking for extremes because once we get to an extreme, we know the market will probably swing the other way. If everybody's super bearish and their money is out of the market, then it only takes a little bit of buying pressure to really shoot things higher. There's only one place for your money to go after it's all out, right? It has to go back in. The macro ops trend fragility indicator pinged 0 recently, so super fragile. All our different sentiment and positioning indicators, the AAII, the put call ratios, all of those that we track each week as you've seen in these videos, they hit bearish extremes within the last 2 weeks. Google searches for recession are near all-time highs, which is also why you've not so coincidentally seen all my video titles have Recession 2022 in it. That's what people want to click on. That's where the views are going. And that's another benefit of the YouTube channel. You kind of see where the sentiment is based off what your video titles are. So yeah, try not to get too annoyed when I still have recession in every single title. Moving forward, there's also supportive technicals for this move beyond the charts that we just went over. Breadth right now in the market, which is how many stocks are going up versus going down, is so bad that it's good. So the percentage of stocks that are above their 200-day moving average fell below 20%, meaning most stocks are very beat up right now. And again, the market swings from extreme to extreme, right? And of course, in markets, there's a lot of mean reversion, which we'll talk about more in a second. But if so many stocks are below their 200-day moving average, they're likely oversold and you'll see them rebound. And when they do rebound, that's when you get a rebound in the market as well. Bonds are showing bottoming action. Yields are going down finally. And you know that's a big thing that we've talked about in all these previous videos too, is that a big factor for stocks to actually have a sustained trend upwards is for bond prices to stop falling. Because if bond prices are falling, then yields and interest rates are going up. And that is going to crush stocks every time. So we needed that rate of change in yields to stabilize before stocks could actually find a consistent bit higher. There's some supportive fundamentals too, like consumer spending on services like leisure and travel. It's strong and it's not indicative of a recession. All signs point to core inflation rolling over too, right as the Fed is at peak hawkishness. And this is all supportive of a tradable multi-week bottom. Here's a tweet from Mark Dow explaining how a lot of asset managers just got their budget reset and now they need to desperately outperform in the second half of this year. And shorting from this point where the market is so low, that's not going to get them the returns that they need. Meaning that a lot of hedge fund managers are going to be buying and buying hard into the end of the year. Because a big thing that hedge fund managers and asset managers and anyone on Wall Street need to worry about is their job. If they underperform too much, they're going to get fired. And in this case, regardless of what they think, like even if they think, oh yeah, I do want to short the market, they can't. Because that's just way too risky because the market is so low already. So the only thing they can do is buy to try to make up the gains that they've lost. And if you have everyone suffering from career risk like that, you could get a strong rally in the market because these guys together manage tons and tons of money. See, net hedge fund positioning is at 18%. That's super low. And 60-40 portfolios, which, you know, we talked about in a previous video, they just had their worst half since 1932. And the 60-40 portfolio is the standard portfolio that they put you in. And it's what most managers use too. 7 asset classes fell more than 7% for the first time since 1981. So funds in general have just been clobbered this year. Careers are on the line and everybody is now under position, meaning they don't own enough stocks. Most of their cash is on the sidelines. So that's a lot of potential fuel for a move higher. Because again, just like when we talk about sentiment positioning, when everyone sold everything, what do they do from there? The only thing you can do is buy back in. That's why we look for extremes in the market. Mean reversion potential is high right now. Markets kind of move in two ways. They trend or they mean revert. That's why when we were talking about so many stocks are below their 200-day moving average, a lot of times what happens is that they revert back to that moving average. That's kind of why we use moving averages like this, right? So we can see kind of the trend of what's going on. And you'll see stocks kind of move around those moving averages. That's because they're trending, but at the same time reverting back to their mean. So if you look at this trend right here in the S&P, what is it? It's down, right? And that's coming from the broader view. But on the short term, you could see it goes down, goes up, goes down, goes up. Every time coming back to kiss this line. And honestly, the line isn't driving the price is driving the line because the line is an average, right? But the line shows you a visual representation of that mean reversion. Even right here, see, came back up. Nothing trends directly down. It's always going to move in kind of a sine wave. So stocks and breadth in this market are deeply oversold at this point. And normally when the first half and Q1 returns have been this poor, the following quarters tend to see strong returns. And that's because, again, a lot of potential for mean reversion. So you can see after really negative drops in all these years, we usually got a positive second half or next quarter of the year. Another way to think about it is from the perspective of a narrative pendulum. When recession chatter is consensus, because everybody's talking about recession, right? And that's why you see it in my video titles. When everyone has taken down risk and is holding high levels of cash, meaning everyone is sold out. And when everyone knows inflation is high and sticky and that the Fed is extremely hawkish, and everybody understands that there's plenty of good reasons to be bearish on the market, well then it only takes a marginal amount of positive news to dramatically swing the price in the other direction. Because everybody is just so super bearish, right? So just a little bit of good news, then it's like, oh, it's not that bad, and you'll see prices swing a lot. I always use this example, but it's just like in earnings for individual companies. So why is it that a company can report negative earnings and the stock price shoots up? Well, the reason why is because likely investors and analysts were expecting something even worse. They were expecting the company to lose 100 million this quarter. And if the company comes out and said, hey, we only lost 50 million, then that's huge because it's not as bad as everyone expected. And you will see that stock price take off. Because remember, markets are always driven by expectations. It's not the actual number that gets printed. It's what people think about that number and what they were expecting that number to be. That's why the market is one big psychological game. You're not actually playing asset classes, you're just playing other people. But yeah, a marginal amount of disconfirming news to the popular narrative will dramatically swing the price. That's how mean reversion in markets works, and it's why trends move in sine waves. Markets are made at the margin. That's why they seem to defy reason a lot of times. It's why you could think things are really bad and then all of a sudden the market's taking off because some news came out that said it wasn't as bad as we all thought. This is how embedded expectations and narrative/positioning cascades work. And again, in this market, yields continue to be the key. We need them to stay below their recent ceiling and move sideways or lower. And this is what we talked about before, right? And so far this is playing out as bonds have gone on a decent rally. We could check bonds right here. They stopped falling and it looks like they're trending up. And again, this is very short term. But again, this trend looks like it's going up. And at the very least, we need it to go sideways, just not drop lower than this. Because remember, as bond prices fall, interest rates go up. So we want bond prices stable or rising. That's the only way the stock market will be able to hold this bottom. So what we need to watch is how bonds are going to react to the first strong up move in stocks. If they start selling off hard again, then we got to be defensive. But if they only trade slightly lower, then we could keep adding back risk. And if bonds keep a strong bid and they keep going up even as the stock market is going up, and then we get confirmatory breadth thrust in the market, meaning the volume is really good and a bunch of stocks are moving together, then we really want to buy in. Because the more positive the signal is, the more likely this is a real bottom, like a long-term bottom. Another thing about this market is the fundamentals aren't that bad. Net buybacks hit record highs in the first half of the year. Look, we're at 682 billion. That's much higher than any other year. And buybacks are an important cyclical driver of market returns. If companies keep buying back their shares, that's a lot of buying pressure in the market, right? That's going to push prices higher. And we're getting a lot of that here, as you can see. And it's interesting because most of what the bearish consensus points to as signs of an inevitable recession are actually just a symptom of the bizarro economic environment we're in. So the collapsing regional Fed surveys and manufacturing data are direct results of the inventory glut. And the inventory glut is a result of companies ordering too many goods because they over extrapolated demand for those goods. Why did they do that? Because it was temporarily boosted because of COVID and the lockdown policies. That forced a shift in consumer demand from services to goods. But now we're experiencing a great convergence as demand for both reverts back to trend. So we're getting more demand for services again and less demand for goods because we're washing out everything that happened during COVID. And this is why manufacturing indices look like they're headed for a recession. But travel booking and leisure spending, they're all looking pretty great. So we think that once the inventory glut gets ironed out, we'll find out that the consumer and our economy are not in completely horrible shape. Sure, they're slowing down, but not as severely as most people predicted. And again, price gets set at the margin, right? So it's a game of degrees, and degrees have leverage when there's strong consensus like we're seeing now. We just need a little bit of not so bad news and price will swing the other way because we are so bearish right now in the market. Insiders have also been big net buyers in this sell-off. Now, like all data points, this isn't a surefire signal, but historically, insiders tend to be decent timers of the market, of course. So you mix this with all the other signals that we're seeing, and yeah, things don't look so bad. So again, we got to keep a close eye on bonds to make sure they're not selling off too hard as stocks rise. We want to watch credit spreads. So we need high yield credit to kind of hold their current bottom and confirm any move up in stocks. You need them to move together. We also want to watch risk on leads like Bitcoin, but we also got to keep in mind that crypto may have lost its signaling value because it's kind of on its way to becoming a dead asset for a long time. But another thing we can look at is semiconductors relative to the S&P. They should lead or confirm the trend up and likely peak and turn over before the move is done because semiconductors, they lead the market. So all in all, if we look at this market, it does seem like the bottom still has a good chance of happening. Now, if you continued on in this note, we talk about a bunch of positions that we're putting on because right now in the macro ops portfolio, we are putting on risk with the idea that we're going to have a multi-week move up. And it's always interesting to see how we manage trades when we're doing this because 90% of successful investing is in that trade management. And all our members in the Macro Ops Collective see all of that. And along with getting all our research. But the important thing is like, how do we apply that research, right? And that's why we show every trade in our portfolio. And that's where a lot of the learning happens. And if you're interested in joining the Macro Ops Collective, we actually have enrollment open right now. It's going to close down at the end of the week, so make sure you join before that happens. And it's not going to open up again probably for the rest of the season. I'm going to put a link to learn more about the collective in this video and down below in the description and comments. Definitely check it out because I know a lot of you would benefit from being in our private Slack channel too. And that's where all our professional money managers in our community go back and forth all day. And there's a ton of great intel in there and it's really cool. And a lot of you ask for kind of a Fallible Discord and things like that, but really we have it over here with Macro Ops. But anyway, definitely check that out. Enrollment is going to close soon. And also watch this video right here. It explains more about what we were talking about with what's going on with the bond market versus the stock market. There is a massive change happening because of the new macro environment that we're headed into. So it's important to understand how that relationship is shifting because it's one of the most key relationships in the stock market. But click this video right here and I'll see you there.